As per SEBI survey, more than 90% of Indian families still invest into FDs. But FDs, क्या actually FDs आपके money को efficiently grow करता है? And if not, then what are the better alternatives as compared to FDs? Friends, welcome to Centricity Insights. My name is Sachin Jusuja. Today we have with us is Aditya Shankar, who is co-founder of Centricity Wealth Tech. So Aditya has been in the wealth management industry from last 17 years. So let's take his views on this subject.
Thank you so much for the introduction. There's one thing that I would definitely want to say. In the last 17 years of me being a wealth manager, I realized that my biggest competition did not come from other wealth managers, right? But rather from an investor's bent towards investing into an FD, the perceived benefit and the perceived safety that he derives by investing into an FD. So if you look at the FD rates today, if you go to a government sector bank or a private sector bank today and ask for FD rates, they are essentially in the range of 6 to 7%.
Yeah, 6-7, yeah.
Right, and the latest consumer price index is roughly for the last month would roughly be in the range of 8%.
Yes.
So if you really see, FDs would degrow your money or rather erode money instead of growing it.
Yes.
So one really has to think or in retrospect whether FDs are really a good investment or are there suitable alternatives to it. So we can explore and kind of discuss the various options that are available as alternatives to investing into an FD.
Yes, that's what our viewers want to know. So
Yes,
what are the
sure.
other alternatives where maybe with minimal risk or without taking any unnecessary risk, so they can outbid these FD returns?
Sure. So, in this particular discussion, in this particular episode, we'll limit our discussion to fixed income instruments only.
Yes.
We will not even go into the purview of discussing equity as an asset class,
Yes.
because there is a certain amount of risk that comes with investing into asset
Of
class.
course, some investors don't want to take volatility risk.
Yes, yes.
So we will talk about only instruments which are related to FDs or which can do better than FDs.
Yes, absolutely. So I think the first and foremost instrument that I would like to discuss would be tax-free bonds. So as you may or may not know, tax-free bonds were issued by some of the largest public sector units in the country sometime between 2010 and 2015. So they were issued at a certain coupon, and today they are trading in the secondary market at roughly a yield of 5%. Right?
Okay.
The one major advantage that a tax-free bond enjoys is that the coupon income or the interest income, which is credited into the accounts of an investor on a particular date every year, is not subject to any kind of tax. So as the name suggests, the coupon or the interest income is completely tax-free.
But Aditya, 5% is, I think there is no big difference between FD and tax-free bonds.
Right.
So why tax-free bonds?
So say if you talk about a fixed deposit, the interest which you earn out of a fixed deposit is not tax-free. So if you take an example of say a 6% FD or even a 7% FD,
Okay.
And if the investor falls into a marginal tax slab of roughly say 30%, just for assumption's sake, the post-tax return will be far less than even 5%. Whereas the coupon income of 5% accrued on a tax-free bond will be subject to no tax. So if we talk on a post-tax basis, a tax-free bond would essentially score much above a fixed deposit.
Okay.
As far as the risk aspect is concerned, a tax-free bond is perhaps as safe as a fixed deposit, or even more, because these are issued by quasi-government institutions, which are essentially, to a large extent or almost 99.99%, they are not subject to any kind of credit risk, which basically means that they will not default on the payments of any interest or principal. Okay. So on the safety scale also, they are at par or even better than FDs, and on the post-tax return basis, they are definitely much better than investing into an FD.
All right. So what are the other options where clients can expect maybe little better yields?
Sure. So the second option as an alternative which I would want to discuss is a corporate bond, right? So a lot of private sector, we just discussed tax-free bonds which are issued by public sector units. Private sector companies and non-banking financial companies also issue certain bonds. By definition and by under the tax laws applicable, the coupon or the interest income earned through investing into these bonds are not tax-free. So they are essentially added to the income as and when they are paid, and essentially the tax applicable would be whatever the tax slab of the investor in question. right?
Okay.
So if say the rate of return of a particular corporate bond is roughly 8%, and if the tax applicability of the investor is 30%, then the post-tax return would come to about 5.6%.
Okay, so around 1.52% extra returns are there as compared to FD if you talk about post-tax basis,
Yes,
right?
yes,
But I mean, this when you talk about corporate bonds, so these are private companies which are issuing debt.
Yes.
So you are giving money to the private companies,
Yes,
right?
yes.
So any risk from that perspective?
Yes, so there are definitely considerations before you invest into a corporate bond or debenture as they are called. For example, the first criteria of even considering to invest into a particular bond is the credit rating. So as you might know, there are credit rating agencies in the country which on a periodic basis issue ratings or credit ratings for most of these bonds.
Yes.
Right, and the ratings are issued basis the current financial position, financial health of the of the company, the capability of the company to service its debt in long term, short term, etc. And they come out with different credit ratings. These credit ratings are almost negatively correlated to the coupons that they pay. So the higher the credit rating, the lower will be the rate of interest. The lower the credit rating, the higher will be the rate of interest.
Fine.
Although there is nothing wrong about this inverse correlation, before investing there definitely has to be a match between the expectations of the investor. So if he has a certain return expectation, it should match the risk appetite of the investor. So an investor is not expected to know everything on his own. So one needs to take proper guidance of a qualified advisor or a distributor who can do all the background work, homework, and the due diligence involved, and advise the investor, about the most appropriate. I would rather say that is the best word to describe it. The most appropriate bond to invest into.
So as Aditya suggests, that proper due diligence with expert advice is needed in this kind of instrument if somebody is investing.
Yes.
And what are the other options apart from tax free? And now we just spoke about corporate bonds also.
Yes.
And what are other alternatives?
So I would definitely want to discuss another variant of say these corporate bonds.
Okay.
This particular variant is called not exactly a variant, but another type of bond which is called a market linked debenture or an MLD. These are also called structured debentures. Structured debentures. So there are many kinds of market linked debentures or structured debentures which are available. They can be structured in any way possible depending on what is the need and requirement of a client. But the type of structured debentures or MLDs that we are discussing today will be a fixed coupon principal protected debenture. Which can be compared to a FD, because right now we are talking about alternatives to investing into an FD.
Yes.
So a structured debenture can be, as the name suggests, can be structured in a way which gives you a fixed coupon and gives you safety of principal. Right? And the biggest advantage that a market linked debenture enjoys is the tax efficiency. Right? So
these are like, you mean to say that these are like corporate bonds only, but the only difference is the tax efficient, MLDs are more tax efficient as compared to the corporate bonds.
Yes. So for example, if you hold a market linked debenture for a period more than 1 year, any gains accruing will be subject to a taxation of 10% plus surcharge, of course. As compared to a debenture where the income simply gets added to the marginal rate of interest, just like an FD. While in a market linked debenture, the gains are not only taxable at 10% post 1 year. However, the difference between an FD and a market linked debenture is that there is always a fixed maturity period before which it is very difficult to exit the debenture, and it is not advisable also to exit it. And also there is no coupon or interest payments which are made before maturity.
So the total lump sum amount you get at the time of maturity, or maybe little before.
Yes, a little before. So good that you mentioned it. So how it happens, how it is usually, how it unfolds with the market linked debenture, you purchase it on a particular date, right? And say if the duration or the investment duration of the market linked debenture is say 2 years, the issuer of the debenture will usually buy it back from the investor say 2 or 3 weeks before the actual maturity. Because if you let a fixed income, a listed fixed income instrument mature, then it is subject, the entire gains will be subject to marginal rates of taxation, which is obviously not the idea here. So it is usually bought back some time period before the actual maturity. but it does not impact the return which is accruing to the investor.
Okay.
So the only two differences are that the taxation is better, but the flip side is that you don't get to enjoy any interim cash flows, just like a corporate bond,
Okay.
or probably even an FD.
Okay.
Right. So this is another very, very popular upcoming sub asset class which is emerging in the country today. And it is definitely very popular with high net worth individuals and large corporate treasuries.
Yeah.
And if there are many wealth management companies which are offering these, or many issuers which are offering at very, very low ticket sizes also, which benefits retail investors.
Retail investors also. Okay, great. So Aditya, I mean, we have been hearing a lot about new asset classes also, and specifically like REITs and InvITs, which not only give you better yields and maybe some capital appreciation also. So can you throw some light on REITs and InvITs also?
So I think this should be, REITs and InvITs should be the highlight of this discussion.
Okay.
Because I started my career back in 2004, and at that point of time we used to hear that the apex regulator, which is SEBI, has been having discussions with different stakeholders about introducing the concept of REIT into India.
Okay.
Since these are almost 40-year-old as a concept, these are 40-year-old in most markets, say Europe or US or even Singapore. And unfortunately it took a lot of time. There were many hindrances, many hurdles, and the good thing is that it has finally been introduced about 2-3 years ago into India.
Okay.
Although these are still very nascent, and there are not too many choices to choose from, but still it's an upcoming asset class, and I'm sure that they will make huge inroads into both retail as well as high net worth wealth management in the country.
Okay.
Now let's discuss what these essentially
what
are.
actually this is. This REITs and InvITs.
Yes, so let's start with the full form first, since these are acronyms.
Yep,
so REITs stand for Real Estate Investment Trust, right? So what exactly is this? This is like a mutual fund is also structured as a trust, right? So REITs are essentially a trust which, instead of holding securities, they hold commercial properties, right?
Okay.
Inside them. These commercial properties are essentially income yielding properties which receive rent from the tenants who are basically using these premises.
Okay.
Right. Instead of a single entity or a company owning these properties, it is collectively owned by the REIT. Now there could be shareholders of this REIT, which could run into thousands or lakhs also.
And how can those retail investors can own these REITs?
Yeah, so by simply buying this REIT off the market, this can be bought like a stock. So you simply buy these off the market, secondary market, like a stock, and you become the owner of the REIT.
Okay.
Now, what are the benefits of owning a REIT is that at a very low threshold, you can buy it for a couple of thousand rupees also. You can buy it for crores of rupees also, as much as you want. There is literally unlimited supply to buy it. And the main benefit that you derive is the income yielding part of it. So as per the applicable laws in the country, roughly 90% of the income that the REITs receive from the tenants has to be passed on or paid out to the investors of the REIT.
When you say 90% of the receipts, so this is the rental yield which the big real estate player is getting, and that he is passing on those returns to the investors.
Yes. So this return is passed on to the investor. The rest 10% is utilized by the management of the REIT to maintain the properties, because there is a certain amount of maintenance, paperwork, regulation, administration which goes into managing these very marquee, huge properties. So 10% of the money is held by them to manage these properties, and a certain amount of portion also goes towards the management fee, because if the management is happening, then obviously it involves a lot of resource and there is a fee attached to it. So and you might also ask that what is the benefit of the issuers of the REIT or the the sponsors of the REIT to even come out with it. So that is just like a mutual fund manager derives fees out of managing a large corpus. REITs also are in the business of managing these properties for a particular fee. So that is the exact nature of their business. So in India there are 3 REITs which are publicly floated: Embassy, Mindspace, and Brookfield REIT. So these are the 3 REITs which are currently held by retail and even non-retail institutional investors in various proportions. The incomes which are generated by these REITs are a mix of dividend interest income. Can be both, and an yearly statement called Form 64B is issued by these REITs to kind of give information to the investor as to what is the exact nature of the return which is coming to them. What if say 100 rupees is paid out during the year, what percentage of the return is say interest income or dividend income, so that it helps in his filing of taxes.
Alright, fine.
Yeah, so that is how the nature of the returns are. Apart from, REITs have a very unique feature. So these are neither stocks nor bonds.
Okay.
But they combine the features of both.
That's why it also requires a separate kind of a statement that you just told. Can you mention it again?
Form 64B.
Form 64B.
Yes.
Okay.
Yes. So
great.
So we just discussed that these REITs pay out income, periodic income.
Yes.
Right. So in this sense, these are like fixed income instruments.
Right.
Right. But they also behave like stocks in a way because they also offer capital appreciation.
Okay.
These are listed like a stock.
Okay.
And over a period of time, they also appreciate. So the total return is a net sum of how much income that you have received and what is the capital appreciation.
Or in short term, is it safer to say that this can depreciate also?
Yes. So these are definitely
like stocks, as you said.
Yes, absolutely. So just like there is a certain time horizon of holding stocks, one should stay away from trading in stocks indiscriminately. Just like that, REITs are also come with a certain time horizon. One should hold it for the purpose of income generation and not for trading.
Yes.
So they can be held comfortably for a period of 5 to 7 years if the objective is that.
So if that asset class will do well in next 5 to 7 years, then obviously that REITs will also do well.
Yes, definitely.
In terms of capital appreciation, yes, they are giving you rental yield also, but apart from that, we can expect capital appreciation also in the longer term.
Yes. So just to give you a very basic track record, so they have been the three REITs overall have been delivering roughly about 15% IRR in the last 3 years.
Oh, great.
So some of the advantages of holding or investing into a REIT is that it gives you a huge amount of diversification in your portfolio at a very low threshold.
Yes.
So if it's say a 100 rupee investment, a 100 rupee portfolio, one can get a lot of diversification in commercial real estate pan India at say even 2 rupees.
Okay.
Right, which is otherwise not possible. You can't afford to buy different real estate, commercial real estate pan India, but with a REIT you can do it.
Okay.
A is that. Second is that it is historically known world over, as well as the limited track record in India, that it has definitely outperformed consumer price index.
Okay.
Which means that it can definitely outperform fixed deposits.
All right.
Right.
Fine. So these are efficient instruments.
Yes.
I mean, there is a good potential for capital appreciation also, apart from the yields which can match the FD or which can do better than FDs.
Yes, absolutely.
Fine.
Second is we mentioned InvITs. InvITs are infrastructure investment trusts. These are very similar to REITs, except that instead of commercial real estate, they hold infrastructure assets. They may contain roads, they may contain ports, they may contain gas assets or power assets. So there are 2 or 3. There is an infrastructure InvIT, integrated InvIT. There is a power grid InvIT.
Yes.
There is a gas InvIT also in the works.
And
in the near future, there might be many more such InvITs. They also, the purpose of coming out with this particular platform is also very similar to REIT, that retail investors should also participate in it as an asset class, which otherwise is not possible individually.
Yes.
So nobody in this country can afford to buy a road project or a power project or a hydel power
These
project.
are into thousands of crores.
Thousands and
but
lakhs
you
of
want
crores.
to take benefit of it, so you can participate with little money.
The similarity also is that with the REIT is also that these are also income generating. So roads collect toll taxes, gas collect, and power projects collect tariffs.
Yes,
so these are all income generating, which can be passed on to the investor. So these are some of the options. But
so there are many options as you discussed. So there are tax-free bonds, there are MLDs, there are corporate bonds. Now we just discussed REITs and InvITs. So obviously there are a lot of options. If somebody wants to consider not only FDs, so there are other options with FDs also. Obviously, some money will always be there into FDs, or maybe just parking, funds will be there.
FDs have their own utility.
Yes.
But for majority, you mentioned a SEBI survey which mentioned that 95% of households have investments in FDs.
Yes.
So I can't believe that 95% of households have a certain utility. I think it's because of the comfort factor that they have traditionally had with FDs. So these are some of the options, but this is not the end of the spectrum. So obviously in coming episodes, we'll discuss a plethora of other options also.
Yes.
Other investments, both simpler and sophisticated, that we'll discuss. But I think that's all that we have for today.
So friends, that's it for today. We'll keep on coming with some more interesting videos, and we will also discuss all these instruments in detail in future videos. Thank you. Keep on watching.